From CNBC article, The Looming Office Space Real Estate Shortage. Yes, shortage. The article notes that there's likely more pain to come in the office real estate market. In some of our coverage and commentary on this space, we've pointed out that this is largely an issue for certain tech hubs, certain urban cores, and also that this is an issue in a large case for Class B, Class C, but not necessarily Class A office. And this article actually is going to focus more on the latter point around Class A, because the article immediately points out that according to Costar, there's a future looming office real estate shortage issue likely to transpire. Now, Costar points out that one key caveat here is it's around Class A office in these urban cores where you could see a looming shortage. According to the article, the more office real estate that disappears, forecast up to 1/3 of office real estate will be wiped out, the more the major players in the market will be vying for the top tier of Class A commercial space. Added the fact that more companies are headed back to an in-office reality closer to pre-pandemic expectations, and competition may be hotter than the weaker end of the market suggests. CoStar's call for an upcoming office space shortage is predicated on a look at the current data on leasing and construction activity compared to recent market history. And when looking at that data, newly constructed buildings aged 0 to 3 years are proven to be the winners. They've attracted over 175 million square feet of net new occupancy since the beginning of 2020, an average of 12.7 million square feet per quarter. By comparison, the quarterly average from 2011 to 2019 for similar properties was 11.7 million square feet. From 2008 to 2010, during the Great Recession, the quarterly average was 13.6 million square feet. From Phil Mobley, National Director of Office Analytics at CoStar Group, modern premium office space remains in demand, just as it has historically, even during difficult economic times. However, the supply, according to the article, will increasingly not be there to support the demand. Currently, buildings aged 0 to 3 years comprise 2.4% of office inventory. Now, that's in line with the average, but less than 30 million square feet has been broken ground in 2023, making this year the lowest for construction starts since 2011. Today, there are about 200 million square feet of office space in buildings aged 0 to 3 years, but that figure would be under 150 million by early 2026 and under 100 million by the middle of 2027. At that point, it will only represent about 1% of inventory. Even in the aftermath of the Great Recession in 2013-2014, buildings aged 0 to 3 years never represented less than 1.3% of inventory. So Mobley goes on to say the very type of space that tenants have historically demanded most, even during recessions, will be in short supply. Article goes on to say this isn't to say there won't be more headlines about trophy buildings being sold at discounted values, but those transactions also mean that now is a time when tenants are getting good deals. Furthermore, in the article, landlords of iconic trophy buildings are offering sweeteners, from bigger contributions to custom build-outs. The number of months offered rent-free. It is not clear how long that will last, though. As more top buildings are sold at depressed values, investors mark down the value of property holdings and bonds go bad. New owners can make their finances work with attractive terms to tenants. But for building owners who will need to refinance in the near term, that game is ending. According to billionaire real estate investor Jeff Green, quote, there will just be office buildings with no tenants whatsoever in markets where brand new buildings will get the tenants. Some of the older buildings just won't have any tenants at all. And if there's no tenant at all for a prolonged period of time, that paper, that bond, will be worth next to nothing. CoStar estimates there's still over half of leases executed before 2020 set to expire. Quote, as companies face these renewal decisions, they are now laser focused on utilization. According to the article, that implies a world in which tenants may need less space, but as they continue to make the case for the world of work to return to pre-pandemic in-person collaboration, competition for the best square footage in the market is heading higher. For companies facing lease expirations that believe in the notion of the office as a tool to help maximize workforce effectiveness and, as a result, want to be in premium locations and not the 10 to 20-year-old iconic buildings, but the newest properties, some of the best opportunities are now, Mobley said. The article basically points out real estate's complicated. It's not as easy to say as offices having problems as we've pointed out. Suburbs are doing differently. Some urban cores are doing differently, different regions are doing differently. We've also pointed out that Class A is doing differently than older buildings, and this article really does take a focus on those troubled markets where Class A is outperforming and why to think that trend may continue.